Let's welcome on board Ramesh Iyer, the VCMD at Mahindra Mahindra Financial Services, and talk about how their quarterly performance was and how is it that they're looking at future visibility. Ramesh, good to have you on the show. In the second quarter, wanted to understand what led to this 237% jump that you've seen in the profits. Walk us through what the quarterly numbers looked like.
So, I would kind of take you a little back to the first quarter end. And when we had met that time, I had made this comment very clearly that once the rural sentiments return back to normal, the commercial activities begin to happen, we would see a sharp recovery and a very smart recovery from that market. And that's been truth of that market. It does fall faster, but also gets up much faster. And we have seen exactly that. Between July to September, things were getting to normalcy, lockdowns were opening up, our branches were beginning to start their activity, and I think the consumers were back on the street running their vehicles, using the products, etc., etc. So clearly their cash flow is what has led to this. And if you see the recovery from the delinquent account which were provided for in the first quarter has reversed itself. Our collection efficiencies have been very, very good all the 3 months, lowest being 95 and 100% being the highest in September. And that's what has helped reduce the gross NPA by close to about 3%. And therefore, the profitability is what is seen. Also, we saw good demand for vehicle, while of course all of us know short supply of inventory was a real problem on the marketplace, but demand wasn't. And we saw a good disbursement growth also of about 65% over the first quarter of last year. So collectively, good disbursement, good collections, reversal of delinquent account, consumer sentiments remaining positive, and the branches all opened up to be on the street, able to meet customers, were a collective outcome.
Sure. Ramesh, in the second quarter, we've seen disbursals for most NBFCs clock at an all-time high. Economic recovery clearly is led by strong rural sentiment, which is, well, you alluded to just now. Help us understand the pockets which are witnessing growth and how the overall credit demand is looking like.
I think without exception, all products we are seeing good demand, whether it is for tractors, whether it's for auto, cars, pre-owned vehicle. I think in all products we are witnessing demand, except maybe heavy commercial vehicle, where single truck operator, self-driving, driver owners, they are the ones who are currently still refraining from adding vehicle. But otherwise, I think every segment we have seen demand pick up. And across the geography, it's without exception, I think in every market we have seen it. So I think overall the economy in the rural market has revived. I think it should also important to understand good monsoons turn good sentiments of the rural market. And with infra opening up is what everyone's expectation is, and it will happen for sure. I think the two together is driving the rural sentiments.
Mr. Iyer, you had guided to this, the improvement in the quality of the book, the improvement in the NPA picture for your company. But just zooming in a little bit further, what areas are you seeing improvement in? Is it across the board, across geographies? How does that picture look?
So very clearly, as I said, without exception, every geography is clearly showing signs of improvement. And you're right, the NPA reversal has been a good story for us. And we believe that going forward, it would exactly be this way, that we would see declining trends of the NPA. And the reason why we're saying it is normally the second quarter isn't the best quarter for rural, given monsoons, activity levels normally are not very high. In spite of all of that, if this is what we have seen in the marketplace, it's a very clear signal of things getting back to normal out there. And, with good monsoon, I am repeating this, but with good monsoon, we do expect the farm cash flow will be very, very healthy. Infra will open up, which will drive cash flows in that market. And, all of this festival seasons, the marriage season, I would believe all of this will get normal. The tourism is opening up, the schools are opening up. So I think in every segment, we will see the operations of the vehicle, and therefore their revenue will go up. There could be a little dampener around the diesel petrol price, which has gone up, But I also believe that there would be repricing of the freight rates as well as the passenger fare, which would happen over a period of time. That should settle down the issue. But I think put all of this together, we very, very strongly think the trend that we see is of the declining NPA, good collection efficiencies, and growth of business.
Mr. Iyer, I think a lot of people look to companies like yours to gauge the sentiment in the rural economy, and quite a lot has been said about the recovery in that sector, saying that it is in fact far faster than was initially expected. What are the specific trends that you're witnessing? I know that you said that broad-based recovery is there, but what are the trends that you're witnessing specifically in the various sectors that you play in the rural market?
I think one thing that we have seen over the past, and then now we're seeing it more profound, is people are keeping back some of their earnings for future emergencies. I think this is their learnings from the first round of COVID or the second round of COVID, where they were suddenly stuck with a problem and they had to meet emergencies. Possibly they didn't have sufficient funds, etc., etc. So I think one thing that we're clearly seeing is people are not wanting to invest all that they have or spend all that they have. I think they are keeping back something for themselves, and then that would be used for emergency. That's one trend that we are definitely seeing. I think the second trend that we are seeing is, we used to see a lot of first-time buyers of vehicle, first-time takers of credit in that market. I think they are getting a little more cautious to say that should we really acquire more asset in this round, or should we kind of wait and watch for some more time? So the general trend or change that we are seeing is a little cautious, wait and kind of watch approach. Other than that, as I said, the excitement is up there.
Hi, Mr. Iyer. Good morning. If you were to look at your disbursements, we've seen a big uptick when it comes to pre-owned vehicles. It's gone up from what, 6% to 17% year on year. Where do you see this loan mix concentrate progressing? How will it pan out?
One is, the percentage change is also an outcome of when other products don't do so well. The overall number, the percentages of within the product mix, it starts to show different numbers. But nevertheless, clearly, a pre-owned vehicle is a growth engine for us. And we see a lot of demand for pre-owned vehicle, especially with the new vehicles not available. People want vehicles, so therefore they are willing to go in for a pre-owned vehicle. And the pre-owned vehicle at the mid-size to low-end segment, the demand is high. Even there, the supply is a major constraint. Not too many people are coming and exchanging their vehicles. I think NBFCs have gone slow on repossessions during the last 1 year. So the stock from NBFCs are not coming up. And therefore, the demand is very, very high as compared to the supply, even in pre-owned. But that's a growth engine for us. But overall, I would think that as we settle down, as the vehicles start becoming available, market starts to become normal, more or less our mix would remain the same, with auto about 30%, tractor about 17%, the car segment about 25-27%, pre-owned vehicle about 15%, etc. Commercial vehicle 6-7%.
Before we let you go, Mr. Iyer, we want to hear your outlook when it comes to funding costs and margins.
So funding cost for us has been one of the best during this time. Sufficient liquidity was available. We are able to raise money through the PSL route. All instruments that is possible, even our fixed deposit, in spite of the rates have come down, we see good traction on the deposit side. So the overall funding cost has definitely remained low. We believe that going forward, it will be stable. We don't see much decrease to this. As at the same time, the lending yields have also remained constant. So that's helped really push up the margin, because the borrowing cost had come down for us, especially when we change our old liability and the new borrowings get done. I think the rates do get corrected for us and we see the margin improvement happening. But going forward, I would believe the margin would remain stable. We don't see major drop in the borrowing cost, nor do we expect that the lending rates will substantially go up.
Okay, Mr. Iyer, we're going to let you go with that. Thank you so much for taking the time out and joining us here today live on the market.